You've probably heard tax laws are changing, but what does that really mean for you and your retirement? Now, in this video, I want to walk you through 5 key tax changes that could help you keep more of what you've earned through 2029 and beyond. So, let's take a closer look at what actually is changing, if it's relevant for your situation, and if so, how you could save on taxes by being in the know. So let's start with the first big change. Your current tax rates and deductions are now, clap with me, permanent. So let me ask, have you been holding off maybe on certain tax moves because you, like myself, weren't quite sure what would happen in 2026? Well, that cloud of uncertainty is gone. The lower tax brackets we've had since 2018, right? 10, 12, 22%, up to 37%. They aren't expiring after all. There was some uncertainty there. So, same goes for the standard deduction. And in 2025, actually, that deduction ticks up to 15,750 if you're single and 31,500 for married couples as a starting point. Now, how do you know if this is relevant to you? Well, think about this. If you've been assuming taxes were going up, and these are the kinds of conversations I'm having with my clients, this might change your strategy, right? It now gives you room, the prolonged lower tax brackets, to slow down, spread out Roth conversions, and avoid rushing big withdrawals to fit things in while brackets are lower. We know they're staying lower. So if you're only going to remember one thing from this part, let it be this: you now have stable, for now, ground to plan on and use it. Predictability leads to better decisions and fewer regrets later. By the way, quick sidebar, most people watching this would score just under 70% on my retirement readiness assessment, and often their lowest score comes from the tax section. So check it out if you haven't already. Links in the description. And no, by the way, I don't require an email address for you to see your score, so have at it. All right, on to change number 2, a brand new $6,000 bonus deduction that stacks on top of, let's say, the standard deduction for just being 65 or older. And this is the kind of change that can fly under the radar because it doesn't apply to everybody. But for people in retirement, 65 or older, this can make a significant difference. So if you're over 65 or 65 or older, by the end of 2025, you'll get that additional $6,000 personal. Technically, it's called an exemption, functions like a deduction. And if your spouse also qualifies, that counts as well, a $12,000 additional on top of deduction. But here's how to know if this really benefits you. It only applies if your income is below $150,000 if you're single, or $250,000 if you're married. Above that, it begins to phase out and disappears completely. So if your income is hovering around those limits, even small adjustments, think about this, like how and when you might take some IRA withdrawals. Do you take it in December, or do you wait till January for a new tax year to reset your limits? That could help you qualify for this. So here's what I would suggest. One, take a look back at your income from the last year. Are you close to those phase out numbers we just mentioned? And if so, this could be a perfect opportunity for some income smoothing or timing strategies, being strategic about when you're realizing and taking income. Now, this deduction only lasts through 2028, so it is worth, in my view, getting proactive. And a quick note, there's more ahead that builds on this. So if one of these got your attention, stick with me. The next change could save you thousands in a potentially high tax state. So that moves us to number 3, SALT deduction relief. I say finally, you say, what does that mean? This has been one of the biggest frustrations since 2018. You've only been able to deduct, and get this, up to $10,000 in SALT, state and local taxes no matter how much you paid. But starting in 2025, that cap actually rises to $40,000 per return, single or married. There are phase out limits. I believe it's 500,000 for a married couple filing jointly. Here's how to tell if this applies to you. Do you pay a lot in property taxes or state income taxes? Do you have a primary and a secondary home? Do you itemize or come close to itemizing on your return? If so, this could be a huge opportunity. The payoff, real savings, especially if you bunch deductible expenses like making extra property tax payments or accelerating state estimated taxes. This new $40,000 limit runs through 2029, and then it's going to go back, or at least at this point is set to go back to the $10,000 number again. If you're thinking about this from a tax planning perspective, there could be a real window here to see some tax leverage. All right, number 4, charitable giving just got more tax friendly even if you don't itemize. So, starting in 2026, if you take the standard deduction, and most people do, you can still deduct some of your charitable donations. This is one of my favorite changes from the one big beautiful bill. That's $1,000 if you're single, $2,000 if you're married. So, how do you know if this helps you? Well, if you're someone who gives every year to charity, but your donations haven't been big enough to itemize, then this is a way to finally get some tax credit for your generosity. There's no phase outs, no income caps, just a clean, simple bonus to you. The benefit, you're getting a tax break for something you're probably already doing. And if you're not, it could be a great time to start thinking about how giving might fit into a fulfilling retirement plan. Now, one caveat for people who do itemize: they have enough in deductions to not need or use the standard deduction. There's a new rule coming in 2026 where only the portion of your donation that exceeds 0.5% of your income is deductible. So if you itemize and give large amounts, you just want to make sure you account for that small tweak in your tax plan for the year. So a quick pulse check, we're 4 in. And the last one is more of a myth buster, but it is important, especially if you've heard rumors about Social Security becoming tax free. So let's finish with number 5, Social Security. And by the way, the taxation is not changing. I've had people ask, didn't they make Social Security tax free in that new bill? Well, no, they didn't. The way actually your benefits are taxed at the federal level stay exactly the same. So why the confusion? Well, probably because with the higher standard deduction and new senior exemptions, your overall tax bill might look lower, but that's not because Social Security itself got any special tax treatment. So, what does this mean for you? Well, don't change your Social Security strategy just because of this bill. If you've been managing your income to keep Social Security taxes low, that work still matters. And if you've been assuming the rules might get better later, you might be waiting a long time. This part of the tax code really hasn't budged. And one final thought before we wrap up: every one of these changes has a shelf life. Some of them expire in 2028, some in 2029, some are permanent for now until Congress changes their mind. The real value, though, comes when you align these changes to your situation before these windows close. And by the way, while this is by no means here an exhaustive list of the changes from the 870-page act that I'm sure every legislator read extremely closely, hopefully, though, it gives you a highlight of some of the key changes so that you feel equipped to plan accordingly. We'll catch you in the next one.